Hi guys, welcome to CADS 3853 module number 25. In this module, we are going to start a whole new topic called terms of sale. So far we have talked about the profit, how to maximize profit and why we need to maximize profit and things like that, and how the profit is translated into pricing strategies and tactics, markups and markdowns and things like that. And then we talked about inventory planning, right? Inventory efficiency and stock planning method. And eventually we talked about how to plan for the entire 6-month season, right? 6-month plan. And in the previous couple of modules, we talked about model stock planning and assortment plannings and things like that. Now, let's say we have budget planned out, we have our pricing plans, and we have our assortment plan. Now, with all these plans, we need to actually go ahead and place orders, right? So we need to pick the vendors and we have to place orders. And so in this module and the next two more modules, we are going to talk about the terms, okay, that we need to negotiate with vendors as we place order and as we get this merchandise in our company or store. Okay, there will be 3 modules of terms of sale, and this is the first of the 3 modules, and we're going to focus on what discounts are available for the buyer to receive from vendors in this business-to-business transactions. Terms of sale basically means all the factors that we can negotiate with vendors before placing orders because they influence the final cost of the merchandise. And these terms usually are called 3Ds because the terms include 3 different things that start with Ds, like discounts, dating, and delivery. There are multiple different types of discounts, and I have said actually here discounts and in parentheses and anticipation. Anticipation is a kind of discount, and I will talk about it more. So it's kind of in the parentheses, but it's part of the discounts. And in this module, we're going to focus on discounts. Discounts are obviously a deduction of the build cost of merchandise. So the more discounts the buyer has, the lower the cost of goods, the merchandise the buyer has to pay to the vendor. Right? We are going to talk about 4 different types of discounts. Okay, first kind is trade discount. The second is quantity discount, and third is cash discount. And finally, we're going to talk about anticipation, which is a part of cash discount, sort of, and you will see why I say it's kind of sort of later. Trade discount establishes the individual item's invoice cost price, so the initial invoice cost price. And then from that invoice cost, we can take off the quantity discount if applicable, to establish the actual build cost. And from the build cost, we may take off cash discounts, okay, again, if applicable. And eventually, after taking off all the trade discount, quantity discount, and cash discount, what's left is what the buyer has to actually pay to the vendor, which is what we call net cost. Here in understanding the different types of discounts, what's really important here is the order of taking these discounts. Okay, there's a specific order we need to follow in taking discounts because all the discounts are given as percentages. It basically percent of what? We have to think about this order for us to be able to clearly understand what these discount percentages are of. Okay, so the order here is that we have to first take off the trade discounts, okay, and then quantity discounts, and then finally cash discount. If there was any anticipation, then the anticipation takes at the same level or order as the cash discount. Anticipation is a little bit complex in terms of the calculation, and we'll take a look at it later in next module, especially the anticipation part. But the rest of the discounts will be covered in this module. But just remember this, the cash discount and anticipation are going to be in the same order. And before cash discount, we have to take off trade and quantity discounts. And before quantity discount, trade discounts have to be taken off first. And here, I wanted to kind of visually illustrate what I just said, kind of to reinforce the meaning of what I said, what I meant by order of discounts. So when you try to purchase anything, place an order of merchandise from a vendor, they may show you pamphlets or samples of the merchandise, right? The items. And as you find the ones that you like to place order, you probably would want to know how much it would cost. Okay. They may give you, instead of the cost, they may give you list price or suggested retail price. Okay. And from the list price or suggested retail price, they will give you the trade discounts percent, which you can take off from the list price or suggested retail price. Okay. So once you take off the trade discount dollar from the list price, what's left is going to be what we call invoice cost. Okay. That now it becomes a cost. And from the invoice cost, we take off the quantity discount, and we'll talk about what quantity discount is later on. But in summary, the quantity discount is basically a discount based on the quantity. If you order a lot, then vendor may give you a discount. Okay. In that kind of case, if it's applicable, then you're going to have a quantity discount off of your invoice cost, not from your list price, but your invoice cost, which will establish your billed cost. So invoice cost minus quantity discount will be your billed cost. And from the billed cost, now you will take off any cash discounts or anticipation that are applicable to your invoice. In that case, if there are any cash discount anticipation you can get, then you take them off from the billed costs, which were what's left after the trade and quantity discounts have already been taken off. Okay. Then what's left for you to actually pay will be what we call net cost. So here's a different terms. Like you start from list price or suggested retail price and take off the trade discounts. And then what's left is the invoice cost, from which we're going to take off quantity discount. What's left is billed cost. After then you take off cash discount and anticipation to finally know what the net cost is. Okay. So here you can see the clear order of discount: trade, quantity, and cash discount plus anticipation. And when all of these discounts are given in percentages, trade discount of a certain percent and quantity discount of a certain percent, etc., you have to know percent of what, right? So trade discount will be percent of list price, quantity discount will be percent of invoice cost, cash discount and anticipation will be percent of billed cost. Okay, because of that reason, we need to be clear in terms of the order of discounts and which one should come first and etc. So we're going to take a look at all the discounts one by one, starting from trade discounts. Trade discounts are defined as a reduction in the manufacturer's quoted catalog price. As I said before, manufacturers sometimes may show in their catalogs or when they share their samples with the buyer, retail buyer, they, instead of showing the cost value, the actual cost they're going to quote or they're going to charge the buyer, instead of that, they may actually show the suggested retail price. Okay, so how much the retail buyer may be able to charge their consumers. So we call these as either suggested retail price, list price, or catalog price. And they suggest the extra invoice cost to show how much markup the retail buyer may be able to achieve. Okay? So the way to establish the invoice cost, the cost that they're going to actually put on their invoice if the buyer purchases the merchandise, is to determining the trade discounts. Okay. So by establishing the trade discount percentages, the vendor determines what the actual invoice cost is going to be as compared to the suggested retail price or list price, and so that the trade discount dollar, so how much is it discounted, could be determined by taking the difference between the list price and the invoice cost. Trade discount is deducted regardless of when the invoice is paid. So among the different discounts the vendor can offer, trade discount has nothing to do with the payment timing. So trade discount is determined, and regardless of when the invoice is paid, that determined trade discounts are going to be deducted. Trade discounts are considered more functional because trade discounts are not really discounts. If you think about it, the list price is a suggested retail price. When we talk about vendor giving discounts to the buyer, we don't necessarily mean taking off the discounts from the retail price, right? We mean, okay, given the cost that they are charging, the vendors charging usually, how much more discounts are given, taken off for this particular buyer. That's what we usually consider as discounts. For that matter, because trade discounts are taken off of the list price or the suggested retail price, trade discounts are not really discounts, but these trade discounts are established as a way for the vendor to establish the initial invoice cost. So the invoice cost that's going to be put on the contract, the purchase contract, or the invoice that comes with that is sent to the buyer along with the shipment of the merchandise should actually already have reflected the trade discounts. So the suggested retail price will never be actually put down on the contract or on the invoice. Because trade discounts are functional, the vendors can use trade discounts in a way to differentiate different buyers. So some buyers are more major player in the market, and they do some marketing activities for the vendors on behalf of the brand. So a lot of times those retailers may get more trade discounts. Whereas if you are like a small retail store in boutique in Auburn, in the city of Auburn, it's pretty small purchase amount, and the role is pretty limited to the local area. In that kind of case, this retail buyer is going to be considered, probably less important than maybe buyers from a large retailer that has a national chain, national store, multiple stores in the nation. So maybe for those buyers, the vendor may give less discounts. So when they do the vendor differentiate the different buyers in terms of trade discounts, instead of changing the percentages, what they do is they establish a multiple trade discount percentage in chain. Like for example, discounts may be listed in like as a 40%, 20%, 5%. Or they may actually write it as last 40, last 20, last 5. What this means is that for certain retailers, certain buyers, they will apply only the first one, 40%. Okay, or some other retailers who are like a medium size that has a medium impact on the market, they may apply two of the trade discounts, so 40% and 20%. And for a larger retailer that is a major player in the market that will do a lot of marketing activities for the vendor may give all three trade discounts in chain, so 40%, 20%, and 5%. And when you apply this series of trade discounts that were given in chain, the way we calculate these trade discounts using these numbers is not additive. That means if the vendor gives you 40, 25, or less 40, less 20, less 5, that does not mean you're going to get 40 plus 20 plus 5, so 65% discounts. Instead, it would mean that that they will perform three calculations. Okay, so applying 40% first, okay, and then 20% and 5%. To be able to calculate their invoice cost, and from that invoice cost and the original list price that they suggested, they're going to be able to take their differences, the list price and the invoice cost, to be able to calculate the trade discount. On next slides, we will actually take a look at what that means in an example problem. So in this example, let's say the list price was $500 for an order. Okay. And three trade discounts were offered, 40, 20, and 5%. Okay, so that would be written as $500 and 40, 20, 5, or say $500 list / last 40, last 20, last 5. Okay, so this buyer received three trade discounts in chain. to apply this trade discount, the first thing that we need to do is to calculate the invoice cost. We don't directly calculate trade discounts right away from these trade discount percentages, but we always have to calculate first the invoice cost and then subtract the invoice cost from the list price to estimate the trade discounts. So to calculate the invoice cost, how much we have to pay, okay? From the $500 list price, the first trade discount was 40%. So take off that 40% first. So 500 times 100% minus 40%, which will be $300. Okay. So basically, you have to subtract 40% of the $500 from $500 to calculate the first invoice cost. And from the $300, you take off the second trade discount, 20%. Okay. Not from the original, the initial list price, $500, but from the answer that was calculated by taking off the first trade discount 40% off already. So that's what's left is $300. From there, you're going to take off 20%. So 20% of the $300 will be taken off, which will lead to $240. And the last trade discount of 5% will be again applied to this answer. So $240 times 100% minus 5% will be $228, which will be your invoice cost. Another way of showing the same calculation to get the invoice cost is this. You can look at it in a more vertical way. So starting from the list price of $500, you time that by 60%, which is 100% minus 40%. 40% is the first trade discount. And you get $300 by doing that calculation. And you time that $300 by 80%, which is 100% minus the 20%, which is the second trade discount. That leads to $240. And then if you get another discount of 5%, then you subtract that out too. So 240 times 95%, that will be 228. And this is the final invoice cost. Another version of the calculation, which is the simplest one that I will recommend you to use, is this one. So $500 the list price times 100% minus 40% times 100% minus 20% times 100% minus 5%, which is 228%. So we don't need to know the intermediate steps of the invoice cost calculation, $300, $240, etc. But as long as you do the series of multiplications, doing the 100% minus the trade discount percent, the first one and second one and third one in this manner, the chain of the trade discounts, and apply them in this manner, you can get the invoice cost. Okay? And this is the simplest among the three methods or three versions of the calculation that I showed you in the previous slide and this slide. So I recommend you to use this one the most, but all of them are basically following the same logic and the same mathematical concept. So once you have the invoice cost calculated, then now finally we can also, if we want to know, then we can calculate the trade discount dollar. Trade discount dollar basically means how many dollars have been discounted, right? Whereas the invoice cost is, so after the trade discounts, how much do you have to pay? So the trade discount is the difference between the list price or suggested retail price minus the invoice cost that we calculate using one of those previous methods that we just talked about. So in this example problem, the list price was $500 initially, and the invoice cost after the three trade discounts, 40% and 20% and 5%, was $228. So that makes the trade discount $272, $500 minus $228. It is very important that to know that the trade discounts can be calculated only after the invoice cost is calculated. Okay, there's no way, no other way for you to calculate trade discount. There's no way for you to calculate trade discount directly by just applying the 40% and 20% and 5% directly to the list price. So don't attempt that. And I've seen a lot of times students make mistake and trying to attempt to do it that way. So don't do that. And remember that trade discount is a discount, kind of discount that you definitely need to calculate the how much you need to pay after the trade discounts first. Then you can figure out how much is taken off as a discount. So in the previous couple of slides, I was showing you how to apply the series of trade discounts in case you get more than one trade discount from the vendor, and how it's not just additive, which means it's not like you can just add up all the series of trade discounts and subtract that from the list price to get the invoice cost, right? So, if it was that way, then, we would probably do this kind of calculation, like a 40% plus 20% plus 5%. So just like 65% trade discount and subtract that from 100% and time that by list price. That way you will get $175 as the invoice cost. But that wasn't the case. In our example problem, we got $228 as the invoice cost. So if you just, apply these three trade discounts in chain of the three discounts in an additive, just kind of adding them up kind of way, then you would have had the wrong answer. So don't try to do it this way, but always apply each trade discount one by one in chain through the method of calculation that I showed you on the previous slide. Alright, so let's work on a practice problem. Okay. So say you're a buyer of lawnmowers and you're buying a lawnmower that lists as $200. So it's a $200 lawnmower as the suggested retail price. And trade discounts that you receive from the vendor are 25%, 10%, 5%. So those three trade discounts. Okay. For each lawnmower, let's find out the invoice cost and trade discount dollars. Let's pause the video. Okay, so let's take a look at the answer. First, we need to calculate the invoice cost first. So list price $200 times the 100% minus the first trade discount 25% times 100% minus the second trade discount, which is 10%, times 100% minus the last trade discount 5%. And this way we get $128.25 of the invoice cost. So this would be what you need to pay to the vendor after the trade discounts. With the dollar trade discounts, so how much was taken off as the trade discount will be the difference between $200, the list price, and this invoice cost of $128.25. So that is $71.75. Okay, so as trade discounts, $71.75 were taken off, and as a result, you will have to pay the invoice cost of $128.25 if you don't have any other discounts besides the trade discounts. The second type of discounts that the buyer can negotiate with the vendor on is the quantity discount. A quantity discount is reduced based on the purchase volume. So either it could be the volume in terms of the purchase dollar, or the number of units in the purchase, based on some minimum kind of criterion that the vendor decides. If the buyer's purchase meets the certain volume criterion, then the buyer will get the discounts. And quantity discount, just like the trade discounts, quantity discounts are also deducted regardless of when the invoice is paid. So quantity discounts have nothing to do with the actual payment timing. And that was the same case for the trade discount as well. The vendor may decide on the quantity discount schedule in two different ways. One is the non-cumulative quantity discount schedule, which means that quantity discount, whether or not the quantity discount is given and how much quantity discount is given, will be decided on based on the volume of the single order. So each single order of the buyer will be viewed against a certain criterion that the vendor sets up. And if the buyer's single order meets the criterion, then the buyer's order will purchase will get the discounts. And it is determined for each single order separately. Whereas the cumulative quantity discount schedule determines whether or not the buyer gets the discounts or how much discount is given, quantity discount is given. All these things will be determined based on the running tally of multiple purchases that are made over a certain period of time. So, for example, the buyer may purchase like several times, like 5 times during a year, and maybe the vendor will have a quantity discount schedule for the entire year set up. And if the buyer's purchases all together, the 5 purchases all together, cumulatively reach it or exceeded a certain minimum level, then the buyer will get the quantity discounts. Alright, so let's take a look at an example of quantity discount problem here. Okay, so let's say that manufacturer of upholstery fabric offers a 10% quantity discount on orders of 100 yards or more. So 100 yards is the minimum requirement to receive a quantity discount. And the cost of the fabric is $28 per yard. Okay, a designer orders 125 yards. Let's calculate the amount to pay. So here, the 100 yard is the minimum requirement to receive a quantity discount, and this designer ordered 125 yards. So certainly this order meets the requirement for getting the quantity discount. So there will be a quantity discount, and in this case, it's 10% quantity discount according to the problem. The question is asking you to calculate the amount to pay. So this is a build cost after quantity discounts have been taken off. How much do you have to pay as the build cost? That's the question. So we'll have to apply what the first we'll have to calculate how much was the initial cost, the invoice cost, when the fabric is $28 per yard, and when you're buying 125 yards of that, and then calculate the quantity discount based on the 10% quantity discount, and subtract that quantity discount from the invoice cost to be able to know how much you have to pay as the build cost. Okay, let's pause the video and work on the problem. Alright, so let's calculate quantity discount dollar first. It's 105 yards and $28 per yard, so that will be 125 times $28. That would be the invoice cost, right? If there was no quantity discount. Then 10% of that will be discounted as a quantity discount because the designer's order met the minimum requirement for quantity discounts. So that is $350 quantity discount. So the build cost that the designer has to pay will be the original invoice cost, 125 times $28, minus the quantity discount, $350. So that will be $3,150. You can calculate the build cost in this two-step manner, or you could calculate build cost by doing the 125 yard times 28 yard per dollars per yard. And then from that invoice cost, you just time that by 100% minus 10%, and 10% is the quantity discount, and you'll get the same answer of $3,150. Let's work on another practice problem of the quantity discount. Okay, in this case, let's say the buyer purchases the merchandise scarves, in this case, at a cost of $13.75 per dozen. Okay, and the following purchases were made throughout the year. Okay, so in February, if you look at the green box on the left side of the screen, there's month and quantity, the purchase quantity. So in February, 3 dozens were purchased. In July, 5 dozens. October, 7 dozens. And November, 9 dozens. So there were 4 different purchases, purchase orders, and in different quantities. And based on the above cumulative quantity discount schedule, based on this phrase, we can assume that the discount schedule that is given on the pink box on the right side of the screen is based on a cumulative schedule. Okay, so that means that discounts will be determined based on the accumulated orders, multiple purchase orders that the buyer made throughout the whole year. Okay. So in this case, the discount schedule says that when the total quantity, purchase quantity is between 1 to 7 dozen, there's no discount, 0% discount. If the purchases and cumulative purchases amounted to 8 to 14 dozen, there's going to be a 1% discount. And between 15 to 21 dozen purchase, a 2% quantity discount is applied, and over 21 dozen purchases, a 3% quantity discount will be applied. And this purchase quantity is accumulated purchase amount. Okay. So given this discount program or schedule, let's calculate the quantity discount dollar. Okay. And the build cost after the quantity discount is taken off. Okay, so since this says it's a cumulative quantity discount, we're going to have to add up all the purchases amounts for the entire year, and then see if the sum of the purchases will be applicable to any of the quantity discount criteria on the pink box. Okay, so let's work on this problem. Let's pause the video. So first, we have to figure out how many dozens of scarves were purchased throughout the year by this buyer. So we combine all the purchase orders together. So there were 4 purchases, 3, 5, 7, 9 dozens each, and combining them together amounts to 24 dozens. And according to the discount schedule, over 21 dozen purchases cumulatively will lead to a 3% quantity discount. So in this case, a 3% quantity discount is going to be applied. So given the 3% discounts, we first know what the quantity discount dollar is. Okay, each the dozen scarves were $13.75. So that times 24 dozen, that will be the invoice cost. Okay. And that times 3% quantity discounts, that will be actually $9.90. So cumulatively, the buyer will get a $9.90 quantity discount. So the build cost that the buyer has to pay after the quantity discount is taken off for these 24 dozen scarves will be the $13.75 times 24 dozen. That is the invoice cost. That invoice cost minus the quantity discount, $9.90. Okay, or you can do it also just by timing that invoice cost by 100% minus 3%. So to calculate the build cost, in that way you don't really do the calculation of the quantity discounts dollar first, but you can just straightforwardly just go and calculate build cost to begin with. Either way is fine as long as the question is asking you to calculate the build cost. But if the question is asking you to calculate the quantity discount dollar, so how much is actually discounted as the quantity discount, then you're going to have to go through the first step, the quantity discount dollar calculation first, and then based on that, you can also calculate build cost. So in the previous problem, the quantity discount schedule was based on a cumulative purchase orders, right? What if the discount schedule given in the previous problem had been non-cumulative quantity discounts? Okay, if it should be a non-cumulative quantity discount schedule, then what would be the total quantity discount dollar granted for the 4 orders altogether, and the total build cost after the quantity discounts have been taken off? Okay. So this question now kind of changes the circumstance a little bit, so that the quantity discount is non-cumulative. That means each single order will be reviewed separately, right? So for each single order, you will have to check with the discount schedule and see if that order is applicable to any of the discounts. Okay, So and then for those orders that can be eligible to get quantity discounts, you're gonna have to be able to calculate quantity discounts. And as a result, what would be the total build cost the buyer ends up paying for all 4 orders? That's the question. So let's work on this, but let's pause the video. So first we had to check our each of the 4 orders against the discount schedule. And we found that the February, July, and October's orders were all 7 dozen or below. So there's 0% this quantity discount that the buyer could receive for these 3 orders, right? Only the last order, the November order, was that was 9 dozen orders. So it was applicable to receive a 1% quantity discount. Okay, so only for the last order, the November order, a quantity discount can be given, and that quantity discount percent will be 1%. Okay, so the total quantity discount dollars that the buyer can receive is basically 0 quantity discount dollar from the first 3 orders, and from the last order, the buyer can receive $1.24 quantity discount because it's 1% of that 9 dozen orders. 9 dozen times $13.75 per dozen, right? So that will be $1.24. That will be the total quantity discount dollar. So the total build cost the buyer will end up paying to the vendor will be the total invoice cost of 13.75 times 24 dozen minus that quantity discount from the last order, November order. So that was $1.24. So the total build cost will be $328.76, which is a bit greater than the build cost that we calculated based on a cumulative quantity discount schedule. Another discounts that the buyer can negotiate with the vendor about is cash discount. Well, we've heard this term cash discount a lot before too, and the exact meaning of the cash discount is the reduction in the cost for prompt payment. So now the discount, cash discount, whether or not to get the cash discount and the cash discount amount and things like that are depend upon when the invoice is paid. When I explained the quantity discount and trade discount, I said those 2 discounts have nothing to do with the payment timing. Now, cash discount is completely determined based on the payment timing. So the payment timing is the important factor of deciding whether or not to get the cash discount and how much cash discount is received. Unlike the name cash in the cash discount term, whether or not you receive the cash discount has nothing to do with whether or not the bill was paid in cash. So it is not about whether the bill is paid in cash, but it is about when the bill is paid. Cash discount is a reward that the vendor gives to the buyer for prompt payment, paying early. Okay, so the cash discount has to be recorded on the purchase order on the contract as part of the terms of sale. So it must be discussed with the vendor before you place the order. And as I said before, in terms of the order of discounts, cash discount is the 3rd order, which means it has to be taken off after the trade and quantity discounts are first taken off, right? So the trade discount is the 1st order, quantity discount is the 2nd, and the cash discount is in the 3rd order of discounts. When the cash discount term is recorded on the purchase order or the invoice, it follows a certain format. Okay, so for example, here you see 8/10, net net 30. Or you may see something like 8/10, n/30. Okay, both ones, the first 8/10 net 30 and the one in the parentheses 8/10 n/30, they mean exactly the same thing. The first number, which is 8 in this example, indicates the amount of cash discount. So 8/10 means you're gonna get an 8% discount. The second number, which is the number after the first dash, is the number of days for the discounts. Okay, so that means in this case it's 8/10. That means you're going to get an 8% cash discount if you pay the invoice within 10 days from the invoice date. Now the number after net or n slash shows the number of days to pay the invoice without incurring any late penalty. So that is the absolute net amount due with the due date. Okay, so in this case it says net 30 or n/30. So that means the net amount, okay, net invoice must be paid within 30 days from the invoice date. So overall, this example term here, 8/10 and net 30 or 8/10 n/30 basically means that you're going to get an 8% cash discount if you pay the invoice in 10 days from the invoice date, or the absolute net payment due will be in 30 days from the invoice date. So if you pay within the first and 10th days from the invoice date, then you're going to get an 8% cash discount. If you pay the invoice between 11th and 30th days from the invoice date, then you're going to have to pay the invoice, the whole invoice without the cash discount. And since the net payment is due in 30 days, if you pay your invoice after the 30th day, so 31st day or 32nd day or etc., in that case, the vendor has the right to charge you any carrying fees, or like a late penalty basically. So let's take a look at an example here. Let's say we're using the same term that we saw in the previous slide. So 8/10 net 30. Okay, and we purchased 110 units at $16.35 each, and this is the invoice cost or build cost. Let's say this is all after the trade and quantity discounts and everything else. All right, so if we pay this invoice or bill within 10 days, then how much we would have to pay? So the build cost in this case will be 110 units times $16.35, and that will be $1,798.5. And the cash discount will be, it says 8/10, so it's 8% if you pay in 10 days, right? So the 8% of the bill, $1,798.5 will be the cash discount, so it is about $143.88. So the net cost that the buyer has to pay after the cash discount will be the build cost minus cash discount. So that will be $1,798.5 minus $143.88 equals $1,654.62. Okay, so this is when the bill is paid within 10 days. Of course, we could have calculated net cost without actually going through the calculation of the cash discount dollar and subtracting cash discount from build cost. Instead of doing that, we could have just multiplied the build cost by 100% minus the cash discount percent, 8%. And that way we can also calculate the net cost. In either way, it's fine. So the net cost of $1,654.62 will have to be remitted or paid to the vendor if the buyer pays this bill within 10 days from the invoice date. Then what if the term was the same, 8/10 and net 30, and the purchase amount was the same, but the buyer decided to pay the bill after 10 days, but within 30 days of the invoice date? So like, for example, like the buyer pays the bill on day 20. Okay, that's the case, then how much the buyer would have to pay? Then we are dealing with the same build cost, right? The 110 units times $16.35 each. So that will be $1,798.5. That's the build cost. But since the bill is paid on day 20, and then you can get cash discount only for 10 days after the invoice date, but you're paying on the 20th day. So you're not going to get any cash discount, right? So zero cash discount is applied. So that means you will have to pay the entire bill of $1,798.5 as your net cost to be remitted to the vendor. So as we have seen in these two examples, cash discounts are completely depend upon the timing of the payment, right? When the buyer pays the bill. Because of that, the dating terms it becomes very important in determining whether or not the buyer gets the cash discount and how much cash discount the buyer gets, and so on. So we are going to kind of pause the discussion of the cash discount here, and in next module we're going to talk about all different dating terms that affect the period in which the cash discount can be applied, and also the absolute net payment due is determined. So cash discounts will be revisited in next module in more specific examples and of different kinds of dating terms, along with those different kinds of dating terms. And finally, the last kind of discount is what we call anticipation. This anticipation is an extra cash discount. So on top of the regular cash discount, you get this extra cash discount when the invoice is paid, when the buyer pays the bill, the invoice, before the discount period ends. Like in the example that we saw on the previous slide, it was the discount term was 8/10, so that means you get 8% discounts if you pay within 10 days, right? So the buyer has the option of waiting until the 10th day after the invoice date to pay the bill, because the bill, the net amount that the buyer has to pay to the vendor will stay the same for the first 10 days, right, with the same cash discount. So the buyer has no motivation to pay the bill that early, because she or he could wait for 10 days and still get the cash discount. And maybe the buyer decides to just put the money in the bank and accrue some interest as an interest income instead of paying the bill early, right? So the vendor likes to have the payment early. So although the vendor may give the cash discount to the buyer, they may want to even encourage the buyer to pay even early and before the cash discount period expires, right? So that is where the anticipation takes in, and the anticipation was created to promote a prompt payment from the buyer in spite of the cash discount period that's still left for the buyer to wait and to get the cash discount. So since the concept of anticipation is a rebate on the interest the buyer might have gotten on the money, if the buyer would have just left the money in the bank rather than paying the invoice early to the vendor, the anticipation amount is determined based on certain interest rate. And the actual calculation, how to calculate the anticipation dollar, will be decided in discussed in module 26 in next module, because again the anticipation amount and whether or not you get anticipation, all those decisions are depend upon the dating term. Okay, so along with the cash discount, anticipation also are affected by when the invoice is paid. So when we discuss all different kinds of dating terms that determine how many days of cash discount you can get and when is your absolute payment due and stuff like that, you will be able to finally figure out how to calculate the anticipation dollar and the exact dollar for cash discount and etc. So we will deal with those calculation aspect of the anticipation in next module. But on this module, I would like you to remember that the anticipation is the extra cash discount as a kind of a rebate on the interest the buyer might have gotten from the bank if the money has been sitting in the bank instead of being used to pay the bill. So basically, the vendor will benefit by receiving the payment early. So the vendor is willing to share some of the benefit with the buyer. Okay, so that the buyer would feel the motivation to pay early when the vendor has the need to get the money earlier than the end of the cash discount period or the end of the net payment due. All right, so this concludes this module 25, which dealt with the different types of discounts that the buyer and the vendor can negotiate about. Okay, in next module, we're going to go into the dating term as another sales term. So please work on the module problem assignment number 25, and thanks for listening. Bye-bye.